Welcome back, traders and investors. We have a very special guest on today, Ezra Rapoport, trader and head of automated strategies and development for Flammarion Capital. Ezra, how you doing on this pre-Labor Day Friday trading?
I'm great today. I'm great. How are you guys?
We're doing good. Looking forward to the long weekend, a little bit of college football. To start things off, can you just give us your background in the markets and kind of how you ended up here and developing strategies for high-frequency trading?
Sure. It's an interesting story. I started in industrial automation, actually. I didn't start in markets. Fresh out of school, I'm an electrical engineer by training, and I started a startup out of undergrad, sold my share in that, and went into industrial automation. I worked for a boutique automations shop in Atlanta, and we automated large-scale distribution centers, supply chains. There's a significant trend toward automation, especially as production moves overseas. You end up with distribution centers stateside, and large warehouses, which were previously staffed by thousands, are now staffed by, say, a dozen workers, and a fair amount of investment in automation infrastructure. And the boutique firm I was working for at the time was developing the automation that would radically reduce the manpower required to run these large-scale warehouses, et cetera. And we had very large clients, and this is actually something now that Amazon is excelling at. Right, it's this investment in artificial intelligence and automation and infrastructure is actually significant, and it was a very exciting place to be. But I took my my automation discipline, and I was put in contact with a trading shop in Chicago back in 2008, and they were looking to automate a large portion of their Eurodollars portfolio. A lot of, they were significant participants in the Eurodollar futures complex, and they felt that a fair amount of their trading was systematic, and they were looking for somebody who understood the automation and could implement system-critical automation. And so I moved to Chicago, and they taught me to trade essentially, and I helped them automate, a huge portion of their volume. And that's basically how I got my start. That's why I'm partial, I think, probably to interest rate futures. Although I'll trade any market, but I have a certain affinity for that. And so basically, I learned to trade in Chicago in the futures markets and the treasury markets, and from there. It was automated trading, for life, I think.
And Ezra, so I watched your Twitter account there, and you tweeted yesterday something which I found interesting. You talked about diversifying strategies, especially in a low volatility environment. You talked, you trade the futures. Talk about this diversifying strategies. Like, how many strategies are you running, and what's your thought process behind that?
Sure. Well, my platform is designed to run, dozens of strategies at a time. Anytime, I think I see hedge, I try immediately. Once it's demonstrated in one product, the idea is to scale it to as many products as possible. That's one of the benefits of solid automation. And basically, what that allows also is rapid development of new strategies, and I think it's very important always to be just testing new strategies constantly, even just in one lots. And one of the things that will happen as you do that is I've noticed that one develops a diversified portfolio of strategies, and one thing I've noticed is that if for me, as where I'm trading fair amount of volume. There's dependence on a certain amount of volatility. to execute my trades, or a certain amount of volume in the market to execute my trades. And so one thing I noticed is that when the volume in those trades falls off, it's nice to have other trades that aren't as correlated to volume in the markets for their for their profitability. And the tweet you mentioned from yesterday, I talked about how certain spreads continue to move nicely, even though the legs might be a little illiquid. And that's certainly one place that I think is good for everybody to look, is try and construct spreads between related products.
Do you think the volatility helps the lower volatility environment helps your strategies, or does it hurt your strategies? Because, I've been a prop trader for 15 years, and I always like it when volatility increases here. From a pure automation perspective, though, is the increase in volatility, that obviously increases risk, but it also increases return. Do you like the low vol environment, or do you like a little bit more volatility?
Given my, ideal scenario, I would have stationary markets with everybody hitting bids and offers left and right, just the markets didn't move at all. That would be great. That would be my day in the sun. Lots of volume, low volatility. But it's about realizing in reality that that's unlikely.
Is this so? And now you're obviously not the only high frequency trader out there. There's a lot of high frequency traders that are doing and running similar market making type strategies or arbitrage type strategies. As the market becomes more automated, do you think that actually reduces the volatility because you get more and more traders trading those strategies, and it just thickens up the market?
I think about that all the time, and I think that it's a very good question. Currently where I'm at is that basically I think that lower volatility may be a systematic trend that we see going forward, and I think it may be related to automation in the markets, but not necessarily a direct consequence. I think that the lower volatility that we see, and this is purely my own theory, is basically I think it's a result of the increased efficiency that we're seeing throughout the market, and basically the fact that large sell-side institutions are starting to take on large amounts of automation. It allows them to do their job so much more efficiently. Market participants are participating so much more efficiently due to automation becoming widespread. And I think that increase in efficiency will spur a long-term trend toward lower volatility. That is my own view.
Are the markets becoming too efficient?
Also interesting. I also see this related to the low interest rates. I think that this is a reason that interest rates aren't going to spring back necessarily, because I think that the lenders, large scale lenders become so efficient that they shave away at their margins and on their lending costs, and the competition becomes so steep. And that basically I think that continues to push that's going to push rates lower and lower. It certainly complicates things. How about that?
Ezra, Joel here. Do you trade the same markets every day pretty much, and you pretty much have your systems designed for those markets, and then you get as much out of the system as you can in that market, and then once the the results begin to diminish, do you move to something else, or do you like to pick on the same markets almost on a daily basis?
I try to force myself always to be branching out as much as possible, always. I think that the minute you get comfortable, I think that's a very dangerous feeling. And it's tempting to learn to love the markets that, that maybe, have been working for you, or that fed you for the last 5 years or whatever. But I think that that's a very dangerous feeling And I think that I'm not the most seasoned in this field. I'm still fairly young, but I think that the way to be to have longevity in trading is to constantly be be searching and be looking and be expanding your what markets you trade, how you trade them, what asset classes. You have to constantly be looking, I think.
Are you fully automated with no discretion, or do you have some discretion in your trading? And also, when you're compiling your data, with whatever instrument are you trading, are you looking at like the 24-hour market? I mean, Dennis and I like to use the pre-market trading parameters, and the movement in the S&Ps really dictates a lot of our actions early in the market. Are you just focused on the regular hours of trading, or do you encompass the 24-hour market?
Well, I try to be trading all the time because basically for me, the more transaction, my transactions, have very low profit per transaction, so I try to be constantly trading. But I think that as to your question about do I look at 24 hours or what duration of data, what resolution of data I look at, I think that that's actually a very interesting question. Systematic or not, automated or not, everybody looks at at some sort of historic look back, or then basically I think that the period that you look back, the period that you're looking at, your 15-minute candles, or, for the last 24 hours or whatever, I think that basically that has to be directly related to the duration of the signal, what your hold period is. How long your signal holds validity should be, directly related to your look back period, right? It doesn't make sense to look at, the last 5 seconds and get a signal that's going to tell you to hold for 2 days from that, right? It has to be in balance, your hold period and your look back period, and that's basically what I think.
And just a final follow-up, and I think people have to, realize this, that for high-frequency trading, I mean, how important commissions are, and keeping the transactions costs low. I mean, they're really, really low now. I mean, do you think they could go any lower?
That is a constant issue for me. Basically, is you really have to be vigilant about your transaction costs. It is absolutely wasted money. It is your your hard-won profits get eroded, by your transaction costs, and I just don't think you can ever be lax about that. I think you have to constantly be vigilant about looking to minimize that.
Okay.
Ezra, let's just change the subject just here. I want to talk about the tick size pilot that's coming up a little bit here in the small caps. The exchanges have proposed a plan to the SEC. They're reviewing it, going to go for a 21-day comment period. And then eventually here, we are going to get wider ticks, it looks like, on potentially 1,200 stocks, 3 different groups, 400 stocks each. What are your thoughts here? Is this going to bring some liquidity into the small cap markets? And do you trade the small cap markets?
I do not currently trade the small cap markets, but in markets I've traded, I've seen tick sizes change. I've seen pilot programs before. This is not new. This is very much not new. Basically, I think that whether or not it turns out that tick size matters for micro caps, I think that the real important thing here is how progressive the industry that we're in is, and how aggressively they are willing to pursue, experimentally and scientifically as much as possible, determining what the best way to serve these markets is. I think that it's easy to hate all the regulatory bodies. There's no way they're ever going to please everyone. And I've gotten my fair share of gripes. But I think that it's exciting for me to see this pilot, because what it's showing is that we are going to be driven by data that we're going to collect scientifically, and I just think that that's that is the ultimate upshot here, really. is that we're in a, it's a great industry to be in, and that's one of the reasons why.
Okay, question: why don't you trade the small caps?
Basically, I've got I haven't had the time to scale into equities yet. That is on my short list.
Okay.
But
So you don't focus on equities really at all. You're more on the futures side of it still. So it's not just a matter of the small caps. Like, is the liquidity, like the lack of liquidity, like a turnoff here for high frequency traders though? Is that why the high frequency traders aren't as much into the small caps? I
would think so. Basically, yeah, I would think because high frequency traders trade with on such low margins. I think they're naturally attracted to highly liquid markets, and especially if there's it's a highly liquid market. But the automation and we'll penetrate to micro caps all the same. It's just a matter of time.
Ezra, do you ever feel that people are like piggybacking your strategies? Once you get something developed, an algorithm picks up your algorithm, and it makes it a little bit harder to get your executions, or are your systems like so unique that really people cannot really piggyback and step in front of you?
There are a couple basic strategies that I think everyone who's got certain infrastructure capabilities is probably deploying. And as a result, you do end up with the musical chair scenarios in certain trades where you've got obvious to see. Anyone looking at the market can see that you've got, a number of large participants all leaning on the same instrument, and there is not enough quantity on that bid that everyone's leaning on to satisfy all the parties who are quoting the related instrument, and it's just going to be a matter of who gets there first. You can see it happen. It happens all the time, and fact of life.
So that's why speed is so critical, because you want to be, obviously, if you're a high frequency trader, you're razor short margin. If you miss that instrument that you're leaning on, that could lead to a substantial loss on that trade, correct?
Precisely. The instrument you're leaning on is your hedge, right? Everyone who gets there, it locks their profit in, and everyone who misses it is exposed. And that's one of the classic, probably the most basic high frequency strategy is spreading related or identical instruments, and that's the essential conundrum in high frequency, is that musical chairs scenario, I think.
Well, thanks, Ezra. This was great, enlightening here, and we want to get you back on here again, so we'll definitely have you back, Ezra.
I can't wait. Thank you so much.
Okay, thank you.